Good morning, ladies and gentlemen. My name is Fotis Kalantis, and I'm with Spartan Delta Corporation. We're here to present our company. I also have my VP Corporate Development here with me, Mark Hudson. And I'm going to give an introduction to the company. Spartan Delta is the fourth iteration of the Spartan companies. The Spartan team has been around for 12 years. Many people of the team and many of the board of directors have been with us for the last decade. We sold 3 previous companies. 2 of them were in the Cardium and 1 in Southeast Saskatchewan. And this 4th company, we just started before about 9 months ago with the recapitalization of a small public entity called Return Energy. We raised $25 million, and then we start looking to acquire assets. The business model at this point is to acquire a diversified portfolio of assets that we can restructure, optimize them, both financially and operationally. And those assets need to generate free cash flow. At the same time, we are looking for size. We talked to many investors before we started this, and everyone is looking for the economy of scale and a sizable company. So our goal is in the next 24 to 36 months to get to 100,000 BOE a day. We're now about a quarter of the way there. And it's all about, of course, liquidity in these current markets. Another important component to our company is ESG. We are planning to be a leader in ESG and the associated acquisitions that we're going to do. Post Redwater in Canada, it's very important the abandonment liabilities in the acquired assets. So when we evaluate those assets, we pay attention to the future abandonment liabilities, and we specifically put value on those. And the assets that we are going to acquire, they are going to have to generate enough capital for maintenance capital. They are going to generate enough capital to proactively clean it up, and of course, free cash flow, which is the most important thing at the end for investors, is for us to be able to generate free cash flow. So that's kind of the general strategy. And we have started, of course, this acquisition strategy. The current company, today we have, we're about $175 million market cap. Our debt is about $28 million. That's as of June. Our numbers are going to change for the better in the next few days. We're going to have our Q2 press release on Thursday morning. But but these numbers are as of June. The current guidance that we have out there is anywhere between 24 to 26,000, depending the drilling activity in the field in Q4. They're currently insiders control about 26% of the company, and our production today is in the 26,000 barrel a day range, 70% gas, about 20% NGLs, and between 6 and 9% oil and condensate. The areas is in central Alberta and in in Peace River Arch. In central Alberta is where we have the majority of the production, and it's a rich gas focus area. And of course, we have a small toehold in Peace River Arch in the Charlie Lake oil prospect, where we have about 250, 300 barrels a day, and some infrastructure with a gas plant and quite a few upside drilling opportunity there in both the upper and lower Charlie Lake. So if we go to the next slide, on June 1st, we closed the acquisition of the assets of Bellatrix Exploration, over 25,000 barrels a day, 30% liquids, both in the Spirit River and the Cardium Formation. The current decline is under 20%, which of course allows us to have a low maintenance capital for that, and significant booked reserves. Our proved reserves are over 185 million barrels oil in place, and over 600 drilling locations. Significant infrastructure. The estimated replacement value of the infrastructure that we control is 200 million, with over 90 million a day of gas plant capacity, 200 million a day of compression capacity, and over 500 kilometers of gas gathering pipelines. The asset, as we said earlier, we pay attention to the asset retirement obligations. So this is a very clean asset. It's a new asset, and therefore it has a very good LMR. LMR is a ratio basically of the asset value against the retirement obligation cost. So this is a very clean, of course, asset. Another important point here is significant amount of the production comes from the Uchis First Nation Reserve. So we are building, of course, a very strong partnership with the First Nations here. The deal, of course, we announced on June 1st was a great deal. We paid about 2 times net operating cash flow for this at the end of May strip pricing. And of course, since then, strip has improved significantly. So today, probably we paid less than 2 times cash flow for that asset, and about 4,300 barrels per flowing barrel. The total cost of the deal was about $108 million, 7.5 in cash, and about 21 million in assumed liabilities, mainly unpaid bills and royalties. This asset, of course, in the past was burdened by many take-or-pay contracts, and both in terms of transportation and processing. And it had a significant debt load. Through the restructuring process, most of these contracts were disclaimed, and of course, a significant amount of debt was cleaned up. So currently, there's only about $28 million debt on this asset, and we cleaned up close to 70 million barrels, so $70 million of $70 million per year in transportation and processing contracts. Also, the land base here is a significant land base, over 130,000 net acres of undeveloped lands. Next slide. This is a highlight of the reserves on this asset. As you can see there, about 70 million barrels of proved developed producing reserves, 185.5 of total proved reserves, and 2P reserves, of course, 268 million barrels equivalent. So a significant reserve value. And in terms of the drilling inventory, we have in total over 600 locations, both in the Cardium. Of course, Cardium is more oily, and the Spirit River, which is more gassy. Even at today's strip pricing, we have a significant number of locations that they can generate over 60% RR. And you can see a couple of examples at the bottom of this page. For example, the Flare B well, which is one of the subunits in the Spirit River, at strip pricing still generates over 100% rate of return and the payout of 1 year. And of course, as oil gets better, and in this case, gas is already better. So this well itself today at strip pricing probably generates 120% rate of return. And then another example is the NOTIKEWIN, again, another Spirit River sub unit that it has a very good rate of return and about less than a year and a half of payout. If we go to the next page, this is some of the economics using the historical data of the wells that they were drilled on this asset in the past, in the last 2-3 years. And you can see the type well here. And this is 1 mile wells. As we're going forward in Q4, we're hoping to start a drilling program on this asset. And the goal is to drill now 2 milers because the economics are going to get better. A 2 mile well is going to be roughly about 30% more capital, but it can generate potentially double the NPV. At this, in this example here, we're using, of course, the 3.7 million Canadian for 1 miler.
Managing slides on this end.
For the economics here showing are for 1 miler. Of course, as we're going to start drilling the 2 milers, the capital is, as I said, is going to be about 30% higher, but is going to generate a better return, and the NPV is going to be potentially almost double here. And you can see a number of different price scenarios here, all the way from 35 WTI and $1.75 gas Canadian to the strip pricing in April, which is, as I said, now it's significantly higher. So this project is very economic. We are not showing the 2 milers yet because we haven't started drilling them, but as we're going to start drilling the 2 milers, we're going to, of course, update this presentation. If we go to the next slide, please. The infrastructure, as I mentioned here, we have a significant footprint on infrastructure. Keep in mind that we didn't pay anything for this infrastructure. Estimated value over 200 million Canadian net to Spartan. We have ownership in 3 gas plants in this area. We operate the largest one, the Alder Flats gas plant, 230 million a day. That's a deep cut gas plant, and we operate it. And then, of course, we have a significant pipeline that ties the system and significant compression in this area. And that will allow us both to organically grow this asset and also consolidate this fairway. Next slide. Next slide, please. Thank you. We have, what's very important too is our asset is 100% exposed to echo pricing. And of course, echo these days has a significant move. So we're very happy with that. At the same time, we hedge about 60% of our gas volume when we announced this deal to protect, of course, the metrics of this deal and the free cash flow. As I said, this asset generates significant free cash flow today. We hedge about 60% this year and about 40% for 2021. And this is, of course, the PDP production. As we grow and we have the flexibility to very quickly drill and grow in this area and take advantage to potentially to the winter pricing. Next slide. As I mentioned earlier, significant amount of production in this area comes from First Nations Ochis lands, and we are building a strong partnership with them. We're going to, of course, use qualified and competitive business that they have in this area, and they're also owners, 5% owners in the gas plant that we operate. Next slide. What's important about the current asset, it's in the heart of West Central Alberta, which is basically west of both Red Deer and Edmonton. It's very good area to operate, easy access in terms of infrastructure and pipeline egress capacity. And with our current infrastructure and the strong foothold that we got here, as I mentioned earlier, over 130,000 acres of land here in both the Spirit River and Cardium Formation. On this map, we're showing our Cardium footprint, which is over 85,000 acres. And this asset base, and with the infrastructure that we have, it allows us to consolidate this fairway, both in the gas window and the oil window. So we are going to be looking for additional acquisition opportunities on this map. As I mentioned earlier, we have also a small toehold in the Peace River Arch. That's in the Charlie Lake Formation. That's more oil in comparison to the Spirit River in the south. And of course, this is a small toehold. However, we own our own gas plant that has lots of capacity available. And we have about 60 plus upper and lower Charlie Lake locations. And of course, we like to consolidate and add some more production and land in this fairway, both Charlie Lake and to the south in the Montney. Next slide. To summarize Spartan today, we're an experienced management team. We've been around for many years, and of course, this is the fourth Spartan iteration. We have, of course, added a number of new people on the team, in addition to a number of existing members, both in the management team and in the board. We are going to pay attention to both the environmental, social, and governance issues. This asset, we're starting from a good spot because currently it's a low decline asset, under 20%. And this asset generates significant free cash flow at current strip pricing today. And of course, we have a very strong balance sheet, about $28 million currently. And then, of course, as I said, on Thursday coming up, we're going to announce our Q2 results. So stay tuned. This presentation is going to be updated again on Thursday, and we're going to have a press release on our Q2, where we're going to show how well this asset is being integrated. We have it now for about 2.5 months. And as you saw our press release about 3-4 weeks ago, through optimization, this asset now it's over 26,000 barrels a day. We're also currently planning a drilling program. We haven't finalized it yet, but we're planning a winter drilling program. Significant infrastructure footprint in West Central Alberta, in the Pembina and Willis the Green area, which will allow us both for that organic growth through a drilling program and, of course, for additional acquisition opportunities. And of course, the Charlie Lake in Peace River Arch will give us another opportunity to consolidate and expand the area in Peace River Arch, both in the Charlie Lake and the Montney. Overall here, we're a brand new clean company, no skeletons in the closet, no long-term contracts, take or pay commitments. So we're fresh and ready to go here, and you're going to hear more from us as we both grow this asset and we're also acquiring more assets. Thank you for your time, and I'll take questions.
All right. Well, thank you very much for that presentation. And we do have a couple questions that have come in here. Let me start with the first one here. And as I think about just the difference between maybe some things in U.S. and Canada, you guys mentioned a lot about owning your own infrastructure. What strategic advantage is that for you, your asset, and particularly some of the things that you see in Canada and that opportunity?
Well, first of all, we own a significant amount of infrastructure, not all of it, but and we did, the way this deal was unfolded, we didn't pay for this infrastructure. But if you don't have the infrastructure as you are growing, you are forced to sign a number of take or pay commitments. And then, of course, when commodity changes, of course, in this case, when everything crashed, you cannot grow anymore. And if you don't grow, you still have to pay those take or pay commitments. And then it comes to a point that you cannot do it anymore. So it gives you the flexibility to grow at your own pace if you own that infrastructure. Many people, when they're in a bind, they use it as a form of financing by just selling some of that infrastructure if they don't need it. And of course, if you have your own infrastructure, you can generate another source of revenue through processing fees that you can charge other operators in the area. And also it allows you to do consolidation and acquisitions in the area. So I think owning your own infrastructure drives operating costs down and gives you flexibility in your growth or acquisition model.
So following up on that unit costs, we have a question here talking about, as you execute on your growth plans, can you give us some insight on drilling, completion, and production per unit costs? And are you locking in these prices for a program that enhances investment returns?
Well, details on our operating costs are going to come out on, as I said, on Thursday. Unfortunately, the timing of this conference, we decided to participate without our quarter out. This is on Thursday is going to be the first quarter where we're going to announce all the details on this asset in terms of operating costs. So I cannot really speak to the actual numbers right now.
And that's fair. We look forward to tuning in when you guys report earnings as well. But I think, on that same front, as you think about where there may be opportunities on reducing costs, or is there any efficiencies as you ramp up operations that you can maybe speak to on a very high level?
Yeah, I mean, this asset, because we have the infrastructure and we also both have the drilling inventory, and as I mentioned earlier, a significant number of our drilling locations are economic today. We can go and drill, and this asset right now, it's about 26,000 BOE a day. We could potentially grow it to 35 or 40,000. And of course, if you grow it at that size, the per unit cost is going to go significantly down. At the same time, if we're going to look for acquisition opportunities, you're going to have savings on the economy of scale in the operations. G&A savings is significant. So I think economy of scale is very important in this fairway. And without spending any significant dollars on infrastructure, as I said, we potentially can grow it to 35 or 40,000, where then you're going to see a significant move on the per unit cost.
So another question here, focused on maybe a little bit more on your asset base. Would listing on a U.S. exchange, or is that something you're thinking about, be a part of your forward thinking?
Yes, not in the immediate plan, because right now we're at the venture exchange. The plan is in the new year, we're going to potentially move to the Toronto Stock Exchange. And as we get bigger, we are going to look also into the U.S.
That's fair. As you think about, funding your growth, do you guys have a percentage of cash flow versus equity versus debt that you would ultimately like to be, as you think about that incremental cash flow going to your growth plans?
We always view our balance sheet as an asset. So our goal is to stay below 1x debt to cash flow. Right now, even at current pricing, we generate a significant amount of free cash flow. As we speak now, we're just paying down debt, and by mid next year, we potentially can be virtually debt free. As we are going to be, as I said, we're designing a winter drilling program. But again, the general goal and the strategy here is we're going to live within cash flow, and we're going to drill within cash flow.
And that makes sense in this market. I'd be remiss if I didn't ask you about, and maybe you can give a little bit of expansion on your ESG, and certainly one of the themes here at the conference, and certainly you mentioned your relationship with the First Nations. can you just walk through a little bit on how you think of each, the environmental, the social, and the governance aspects of your business, as you mentioned, being a little bit more of a clean slate and moving forward?
Yeah, I mean, we have the luxury to start a brand new company here, no skeletons in any of the assets. The assets have been cleaned, and because this asset base, it's relatively new asset base. The gas plants were only built and finished a couple of years ago. The pipelines are very new. So the abandonment liability on this asset is very low in comparison to the asset value. Also, another very important thing, this asset base and the compression facilities and the gas facilities, everything is automated. So we're able to measure all our emissions, our methane. We're going to have a very detailed ESG report next year, where we're going to show on a yearly basis the improvements that we're going to have on water usage, emission, methane, all these things. And because the asset is fully automated, we have the ability to accurately measure all those things. Another important thing, of course, is all the drilling activity in the field. We're going to be doing it through pad drilling, where we're going to have, 4, 6, 8 wells per pad. The majority of the infrastructure is already set, so all these pads are already tied in with pipelines, so there's not going to be significant future disturbance. So, and then going forward, when we'll look to acquire, we pay significant attention to how clean the asset is that we're looking to acquire. And of course, if it does have some abandonment, costs, we definitely take that into consideration when we evaluate the NPV of that asset, and we subtract the value of that RO out of the NPV of the acquisition. So that's for the environment. Social, as I said, we try to be respectful in the communities that we operate, and in this particular case, we operate in the First Nations area. We are already building a strong partnership with them. They have their own business where we're going to hire some of those businesses to work for us. They are owners. They're not just taking a royalty. They are owners of some of these reserves and some of the infrastructure. And in terms of governance, of course, we're trying to adhere to all the governance issues and equality and so on.
Let's leave that there. And I really appreciate you bringing the Spartan Delta story to our audience here at Entercom, and look forward to following up with you and listening in to your earnings later this week. So thank you again.
Thank you for your time, and then we're looking forward to talk to you again. And as I said, Thursday morning, we're going to have both a press release of the Q2 financials and the updated corporate presentation. Thank you.